Seeing Charlize Theron Twinkies and the return on assets. This is Ken Boyd at the Accounting Accidentally Suspect spot. So I thought I saw Charlize Theron at the grocery store. I was in the liquor department, not a surprise for me. And I turned to see a tall, beautiful blonde in her mid-40s. She was startling, so good looking that she seemed out of place in the suburbs of St. Louis. Check of the worldwide interwebs told me that Charlize, we're on a first name basis now that we met, is 5'10 and 48 years old. And I didn't say anything to her, but I was convinced she was in town for some reason. Another thing I enjoy seeing at the grocery store are Twinkies, Ho-Hos, Ding Dongs, and cupcakes, all delicious products that we all know from Hostess brands. The stock symbol is TWNK, which I think is pretty clever. Hostess is a great business story to explain return on assets, which I'll get to in a minute. So what happened at Hostess? If you sense that Hostess products disappeared for a while and came back, you're right. There was a great Wall Street Journal article that explains. 10 years ago, Hostess brands declared bankruptcy for the second time in a decade. Two investment firms rescued the snack cakes, paying $410 million for the brands and kicking off a decade-long fix-up job. Then came a dogged quest for efficiency and determined search for the next Twinkie, which culminated this week in a deal to sell Hostess to JVM Smucker for $4.6 billion. You can see that that's a 10 times more than a 10-time return on what they paid for the business. And that's sort of interesting because despite an increasing number of customers focusing on health, Hostess treats can still thrive. The article explains that customers are taking a balance sheet approach to snacking, choosing healthy sometimes and treating themselves to sweets other times. And scarcity played a role in Hostess resurgence. My brother-in-law is a guy who always bought the newest tech device when it came out. It turns out the same thing applies to snacks. Some people really are motivated to buy their snacks. Hostess said it would go out of business in 2012 after the company failed to strike a labor deal with the Bakers Union, which is the big employer for Hostess, their big set of employees. For the next 8 months, Twinkies couldn't be found in supermarkets, and scarce delicacies began to fetch Sotheby's prices on eBay. Everybody wanted them, and there was a shortage. The quote from the current CEO, nobody could gauge demand and the amount of product we needed because nobody had done this. You don't take stuff off the shelf and then go back on. Turns out customers love the product. For me included, it reminds a lot of people of the lunch boxes during childhood. These were a big deal for my generation as I grew up. So how did Hostess recover from this financial trouble? First, they sharply lowered cost. Hostess shifted from 34,000 employees before bankruptcy in 2004, 19,000 in 2012, to only 3,000 today. So you can see less than 10% of what they had in 2004. The new owners operate just 3 of the company's prior 14 plants. This brings us to return on assets, ROA, which is defined as net income divided by total assets. So here's an example I've used for years that explains ROA. Let's say that a plumber has a $30,000 truck and carries $15,000 in equipment to plumbing job sites. $45,000 in assets is used to generate revenue from plumbing work. So the more revenue the plumber can generate from the truck and equipment investment, the higher ROA he generates. Operating 3 plants instead of 14 sharply lowers Hostess investment in assets. So the denominator of the formula, assets, gets lower, the ratio can increase, generating a higher return. Longer shelf life, which improves supply chain. Twinkies aren't nuclear waste, but they're close. I thought Twinkies lasted forever. It turns out it's not true. A quote, by using enzyme and mold inhibitor technology, that sounds fancy, to adjust the moisture of the product, Hostess ultimately prolonged the shelf life for Twinkies to 65 days from 26. Twinkies don't last forever, but now they last closer to forever. So what's the accounting impact? Hostess can store inventory in warehouses longer. They make fewer total shipments to stores. They're going less often. This simplifies the supply chain, lowers costs, and reduces labor expense paid to drivers and staff. So what's the lesson? Take a closer look at the assets to operate your business and the net income or return that you earn on assets. And have a Twinkie because life's too short. So that's it for this discussion. Again, you can find more articles in accounting and finance at my Substack, accounting accidentally at substack.com. Thanks for watching.